BNY, the corporate band of Bank of New York Mellon, are higher on stronger than expected earnings today. They reaffirmed full year guidance. They're, quote, prepared for a wide range of macroeconomic and market scenarios as the outlook has become a lot more uncertain. Let's bring in Robin Vince. He is the CEO of BNY. Robin, it's great to have you here. Welcome.
Great to be with you, Kelly. Thank you for joining us on earnings day.
Listen, maybe you can give us the view from where you sit. Are we in a recession, close to one? What do you think?
I don't think we're in a recession necessarily today, but you never know that until you actually look back with the benefit of hindsight. It's sort of a rearward-looking measure. The way I would think about it is the facts of the economy have actually been pretty good so far this year, but there are a lot of anecdotes, leading indicators, and surveys that suggest that sentiment's deteriorated in a pretty meaningful way. True at the CEO level, that matters for confidence around doing deals, building factories, investing, and true at the consumer level as well. And that matters for spending and comfort in terms of how people conduct their lives. And so those things have diverged. The facts have diverged from the sentiment. And as time goes on, particularly if it takes a while, then we have the risk that actually the facts will move down to meet the sentiment. If this was to be resolved quickly, we'd have a better chance that the sentiments would move up and support the facts.
Do you guys have to follow the supplemental leverage ratio?
So we do. All banks are subject to the supplementary leverage ratio. It's not actually our binding constraint, but it is the binding constraint for some. But we've made the point over the course of time, many times in DC, that we think the supplementary leverage ratio is an ill-advised ratio. Maybe it was born out of the financial crisis at a time when there was a lot of anti-bank sentiment, which was understandable at the time. But the people who pay the price today are market participants. The treasury market is less well supported because of the existence of that ratio, in our opinion.
So would this be, and you see exactly why I'm asking the question. Steve Leisman just raised this, but do you think the Fed might effectively say, okay, it could be time to loosen the rules here. We'd love to see more domestic banks come in and support the treasury market?
Yeah, I think that the essence of this is we want a great economy here in the United States and, for that matter, around the world. In order to have a great economy, we need vibrant capital markets. And in order to have those, we need great sponsors of capital markets, including the big banks, who can provide this critical accordion capability to absorb supply in the treasury market. And if you look back at what's happened this week, and you were just commenting on the fact that we've seen 10 years spike up just today to 458, they've retraced a little bit since then. But it's the ability for banks to absorb supply that helps to narrow bid-offer spreads. That helps to be able to keep liquidity in the bond market. And so what we've seen all across markets this week is we've seen widening bid-offer spreads. We've seen reduction in liquidity in the depth at the top of the order book all across the board. And it's not the best thing for markets when that happens. It's certainly not the best thing when it happens in treasury markets.
Right. And Robin, you guys, you're the #1 global custodian, #1, clearing firm for broker dealers. Are your top RIA custodian. You're a top global FX provider. So normally a lot of this stuff is kind of quietly humming in the background and maybe a great business for you. Not this week. So can you tell us, as far as you know, whether you've seen kind of a little bit of a seizure in these traditional functionings of the market, especially some of these international flows, or no?
Well, I would not use the word seizure. In fact, we've seen things operate completely normally in terms of the rails and the infrastructure of the market. And that's good news, and that's very important. What we've seen is a reduction in liquidity in the market in terms of the trading side of things. That's a simple buyers and sellers. And so if you can create more buyers in a market and you can create more people who can step in for a period of time to the buying market, that's helpful for liquidity. And that's, I think, why thinking about what is in the interests of the United States, have a vibrant bond market, vibrant capital markets, that's a reason, I think, to take a little look at the leverage ratio. But it's not just about that. Ultimately, we have a whole bunch of platforms. We want to support the market, as do the other large banks in the United States, and we can do it. And so this is about unleashing the advantages that large capital markets players can bring to creating great deep markets in the U.S.